Now, Stephen Englander is the chief U.S. currency strategist at Barclays Capital. He joins us from the firm's trading floor in New York this morning to talk about the moves in the currency markets. And Steve, is it accurate to say that this reversal in the dollar, you've been expecting this, right?
Well, we did change our forecast about 10 days ago. It's the first time in a year, actually, that we are viewing the dollar as having potential to rise over an extended period. So, till now we've been dollar bears. So it does represent a change for us.
And it represents a change. Is it largely on the interest rate factor, or is it also about risk aversion?
All of the above. I mean, we do see the market as being intimidated by the prospect of Fed liquidity withdrawal and the further prospect of Fed tightening at the beginning of Q3 next year, the end of Q3, that is. The other part, and I think we're seeing it overnight, is that it's not just the dollar move per se. I mean, in terms of dollar optimism, what we're seeing is that risky assets are selling off pretty much across the board. And the same safe haven characteristics that helped the dollar in the second half of 2008 and actually hurt it, from March to November are now helping the dollar again.
They're helping the dollar for what reason?
I think it's still viewed as a safe haven. I think in this case, Europe is looking particularly weak. We've seen Greek yields run up significantly after the downgrade yesterday, and that seems to be spilling over into some of the weaker emerging market currencies. We're seeing it spill over into commodity currencies in G10, as well as into commodity prices. So right. Safe haven is still a dollar, as well as the yen for that matter.
But I don't get it, because the safe haven play, I understand. We've seen that in working for a while. But what about the fact that if interest rates are rising, that means that the U.S. economy is growing stronger again? So how does that seems to actually conflict with the first view?
Well, I think what we're seeing, and this is a significant part of our view change, is that the gap in U.S. growth relative to Europe is beginning to widen. You see that in the IP numbers that we got this week. You see it in our GDP forecasts. So, till now that gap hadn't been that significant. But what we are seeing is, Europe at least beginning to face some headwinds with respect to growth, and certainly the backing up of yields in some of the European countries are going to hurt it, whereas the U.S. seems to be gaining strength. So I think that this is a period at which the cyclical leadership of the U.S. versus the euro is actually helping the dollar. It's attained a critical mass.
Okay, all right, Steve. And actually, you're seeing the backup in yields in Greek bonds right now, because there's still those concerns about that. Steve, thanks for joining us. Steve Englander of Barclays Capital.